Hello everyone, this is Dr. Hessa Al-Fadhel, the course coordinator of Accounting 112. In this video, I'm going to explain Chapter 2, titled Analyzing and Recording Transaction. The first learning objective in this chapter is to describe an account and its use in recording transaction. As you remember in Chapter 1, we already discussed the accounting equation, and we said that the accounting equation includes asset equals to liability plus equity. And we already know that the asset includes cash, account receivable, supplies, equipment, building, and land. And liability includes accounts payable, wages payable, salaries payable, and equity includes four components: capital, withdrawals, revenues, and expenses. And we already also learned how to read a transaction and analyze the transaction as well. In this chapter, we're going to learn how to record those accounts in what we call general ledger. But before that, let's refresh our memories. As you know, in Chapter 1, we already defined asset, and we said that asset, it's all of the resources owned or controlled by the company. And the example of the asset are cash, land, buildings, equipment, supplies, account receivable. The new addition in this chapter is prepaid accounts. Prepaid accounts is asset. Let us explain more what does prepaid account means. So what does prepaid accounts means? The definition of a prepaid accounts, or what we also call prepaid expenses, are assets that represent prepayments of your future expenses. Prepaid means that we did a payment to cover a future expense. So we paid the cash first, but we did not use it yet. That's why we record it as a prepaid account. To make things easier, let me give you here an example. One example of the prepaid accounts, which is insurance. For example, if you have a car, we usually pay the insurance for the car in advance. We don't pay the insurance monthly. We pay the insurance for example, 12 months in advance or 24 months in advance. And since we did not use the money, yes, we paid it to insure our car, covering a 12 months period or a 24 months period, but we did not use it yet. If you did not use the money of the insurance that you paid, then in this case, we will record it as a prepaid insurance. And prepaid insurance, it's an asset. Again, what is a prepaid? Prepaid, it means that I pay a certain amount, for example, for insurance, for 12 months in advance. But since I did not use the money yet of the insurance, I'm going to record it as an asset. But if, for example, I did an accident, okay, if I did an accident, it means that I'm going to use the money of the insurance. If I'm going to use the money of the insurance, then in this case, we record it as insurance expense. So what you really need to understand here, that prepaid accounts means that we paid in advance to cover a certain period in the future, and since that we did not use the money yet, we are going to call it a prepaid insurance. But if, for example, you did an accident, then you are going to use the money of the insurance, then you are going to record it as an insurance expense. And other also examples of a prepaid accounts, which is a prepaid rent and prepaid services. Liability is the second component of the accounting equation. And as I mentioned in chapter 1, that liability means the obligation or the responsibility of the company to pay a certain amount. And the examples of liability are accounts payable. Second, accrued liabilities. What do I mean by accrued liabilities? We already mentioned that in chapter 1. And accrued liability means wages payable or salaries payable. Now, the new addition in this chapter is unearned revenue. Unearned revenue, it's a liabilities. Please do not get confused. I know that you can see that there is a revenue. And if you see revenue, you'll tell me that this is an equity. But unearned revenue, it's a liability. To understand it, let's see the following example. So what is unearned revenue? Unearned revenue, as a definition, is a liability that is settled in the future when a company delivers its product or services. To understand it more, let me give you here an example. So let's assume that we are a company that provides a service and the client came to us, or the customer, pay me the cash before I provide the service. If I receive the cash before the service is completed, then I cannot receive the cash as a revenue, because we know that the service should be completed first, then I have to record it as a revenue. But in our case here, we receive the cash before the service is completed. So in this case, I'm not going to record it as a revenue, of course, because the service is not completed yet. So in this case, I'm going to record it as an unearned revenue. And unearned revenue, it's a liability. So if you ask me now, why did we record it as a liability? Because we received the money, yes, but we did not complete the service. So now we have a liability or obligation to complete the service first, then I'm going to record it as a revenue. So remember here, if the cash is received before the service is completed, we directly record it as an unearned revenue, as a liability. The third component of the accounting equation, which is equity. As I mentioned already in chapter 1, that equity includes 4 components. Owner's capital, and owner's capital always increases the equity. Second, we have revenues is also part of the equity, and remember, revenues will increase the equity. Third, we have the owner's withdrawals. Owner's withdrawals will always decrease the equity. Fourth, which is expenses. You need to remember that expenses will decrease the equity. So now let's move on to the second learning objective, which is to describe a ledger and charts of accounts. Ledger and charts of accounts. So ledger means a collection of all accounts and their balances in accounting system. But chart, it's a list of all accounts and includes an identifying number for each account. So if you go to Exhibit 2-4 in this table, you will find the chart of accounts. We have assets, liabilities, and equity. Let's take an example here. If you go to the cash is under the asset, and there is an identification number, or they call it identifying number, and it's 101. If you go to the accounts payable, it's 201. If you go to the rental revenue, 406. Why there is an identification number? This is very important, especially if you have a big company. In order to track down the accounts, it's better to have a unique code or identification number to refer to the account easily. Okay, now let's move on to the third learning objective, which is to define debit and credit and explain the double entry accounting. So What you can see here in Exhibit 2.5 is what we call it the T account. And accountants often they use the T account to represent the general ledger account. So if you want to see the effect or if the account is increasing or decreasing, we don't say it's increase or decrease. In accounting, we use debit and credit. So why do we call this as a T account? As you see in Exhibit 2-5, the T account, it's like letter T, a big letter T, where we have credit and we have debit and we have the account title. So the account title is entered on the top of the T account, and in the left side of the T account is always called debit side. And the right side is always called as credit side. And why do we use this? We use this too when we are trying to analyze the transaction and we have double entry transaction, then we are going to say, for example, if they say the cash is increasing, then we need to put the cash in either debit or credit depending on the normal balances. So in order to understand this, let us first understand the main concept of the normal balances. So now we are going to talk about the normal balances. And please note that this normal balances or this slide is very important, so please pay attention. So the normal balance of the asset is debit. What do I mean by the normal balance of the asset is debit? It means that if the asset is increasing, it will always increase on the debit side. And if it will decrease on the credit side. Remember, the asset normal balance is debit. When I say normal balance, it means which side is going to be increased. For the liabilities, the normal balance is credit. What do I mean by normal balance is credit for liabilities? It means that if the liability is increasing, then I have to record it on the credit side. And if the liabilities is decreasing, then I'm going to record it on the debit side. Okay. For equity. For the equity, you have to pay attention. As we mentioned earlier in this chapter and in chapter 1, that the equity includes 4 components: capital, withdrawal, revenue, and expenses. Let's take the first example. Revenue, the normal balance is credit. It means that if the revenue is increasing, I have to record it in the credit side. If the capital is increasing, it means I have to record it in the credit side. So the normal balance of the revenues and capital is credit. Expenses, the normal balance is on debit. It means that if my expenses is increasing, then I have to record it on the debit side. And if the withdrawal is increasing, I have to record it on the debit side. So expense and withdrawal normal balance are debit. Let's take another example. Okay, now let's take an example to make sure that we understand what does normal balance means for the assets, liabilities, and equity. If they told me that the company received 200 as cash, so now we know that cash, it's an asset. And now they're telling me that the company is receiving 200, which means that the cash isn't going to increase. If the cash is going to increase and the cash is an asset, so I'm going to record the 200 on the debit side because the cash is increasing. Well, if they told me that the cash is decreasing by 50, so where I'm going to record it? Of course, I'm going to record it on the credit side. So because the cash decreases. Now, if they told me that we have an accounts payable and they told me that the accounts payable increases by 100, we know that accounts payable, it's a liability and the normal balance of liability is credit. And giving the example, they told me that accounts payable is increasing by 100. So it means that it's going to be increase on the credit side. Why? Because accounts payable, it's a liability and the normal balance of the accounts payable is its liability. And if the accounts payable is increasing, it's going to increase on the credit side. Revenue. We know that revenue is part of the equity and the normal balance of the revenue is credit, which means if it's increasing, it's going to increase on the credit side. So now if I give you an example and tell you that if the revenue increases by 1,000, where you are going to record it, debit or credit, of course, it should be on the credit side because the normal balance of the revenue is credit. Capital. Capital is also part of the equity and the normal balance of the capital is credit. So if they told me that the company has a capital of 500, so it means that the capital is increasing, and if it will increase on the credit side. Expenses. Expenses is part of the equity, and as we mentioned earlier, that the normal balance of the expense is debit. It means that if the company expenses are increasing, they are always going to increase on the debit side. So if they told me that the company just paid expenses of 400, which means that my expenses is increasing. So where I'm going to record the 400? Of course, I'm going to record it in the debit side, as the debit side is the normal balance of the expense if the expenses is increasing. Let's move now to the fourth learning objective of Chapter 2, where we'll learn how to analyze the impact of transaction on accounts and financial statements. So now we will learn how we are going to process a transaction. Now we know the normal balances of each account. What we need to do is we need to analyze and process the transaction. And to analyze each transaction, we need to follow 4 steps. The first step, we need to identify the transaction and any source of document. Second step, we're going to analyze the transaction using the accounting equation. Third step, we will learn how to record the transaction in journal entry form applying the double entry accounting. The fourth step is to post the entry in what we call it T accounts. So let's look at some examples. Okay, so let's see the first processing transaction number 1. As we said, when we are processing the transaction, we have 4 steps. The first step is to identify the transaction. So we have here, fast forward, they received 30,000 cash from Chess Tyler as an owner contribution. So Chess Tyler, he invested his money to start up a business and he paid 30,000 as a cash. So now remember, when an owner invests his money in a business, it means that my cash will increase and my capital will increase. So to analyze, the second step is to analyze. So we said that because the owner, he invested money in the company, so to analyze that, we say cash is increasing by 30,000 and capital is increasing in 30,000. We already explained the analysis in Chapter 1. So now, cash is increasing and the cash, it's an asset. So if the cash is increasing, where should I record it? Debit or credit? Of course, debit. Why? Because the normal balance of cash or the asset is debit. So when the cash or when the asset is increasing, it will always increase on the debit side. And capital. Capital, it's part of the equity. But what is the normal balance of the capital? The normal balance is credit. So the capital now is increasing in the credit side. The third step now, which is the important step, pay attention here, is to record. The recording here, we always record what we call it the journal entry. In accounting, when we are recording the journal entry is two lines. The first line represents the debit side. So the first line, it's two lines. The first line represents the debit side. So we always start with the account that increases on the debit side. So in our case, cash is increasing. And we know when the cash is increasing, it means it will increase on the debit side. That's why we start in the first line when we are recording the journal entry. We say cash and we record 30,000 on the debit side. The second line always represents the credit side. So that's why we put capital on the credit side, on the second line. Why? Because the capital is increasing and the capital normal balance is credit. So that's why we record capital 30,000. So remember, when you are recording the journal entry includes two lines. The first line represents the debit account or the account that should be recorded on the debit side. And the second line, you should record the account that represents the credit side. So we said cash on the debit because the cash is increasing and the normal balance is debit, and capital on the credit side and the second line because it's increasing on the credit side. So the third step is to record the journal entry. Remember, the journal entry includes two lines. The first line, debit. The second line is credit. Now, the fourth step of processing a transaction is posting. So we need to post those two accounts, cash and capital, in T account. So I have to prepare two separate T accounts. The first one is representing the cash and the second one represents the capital. Okay, so when we are posting here the transaction, remember, how many accounts do I have? I have two. I have cash and I have capital. When I'm going to post it in a T account, I have to draw two separate T accounts. One T account represents cash accounts and the other T account represents the capital account. Then for the cash, for example, you see that we record here 30,000 on the debit side. Why on the debit side the 30,000? Because the cash is increasing. But when I draw the T account for the capital, I record the 30,000 on the right-hand side, 30,000. Why? Because the cash or the capital, is increasing on your credit side. Let's move on to transaction 2. Okay, let's move to processing transaction number 2. In our second transaction, fast forward, they purchase office supplies and they pay 2,500 cash for supplies. So what happened basically? We purchase supplies. So my supplies is going, if I'm going to analyze it, which means my supplies is going to increase. Why my supplies is increasing? Because the company purchased the supplies. But at the same time, the company pays cash to purchase those supplies. So if I'm going to analyze this transaction, I'm going to say that my cash is decreasing. Why? Because I'm paying cash outside of my pocket or outside from the company's money. So the cash is decreasing. But because I purchase supplies, my supplies is increasing. So both cash and supply, they are part of the assets. But now my cash is decreasing. So if my cash is decreasing, where should I record the cash? Debit or credit? My answer is, of course, credit. Why? Because the company or the cash is decreasing. Where I'm going to record the supply is an asset. And if the asset is increasing, I'm going to record it on the debit side. So cash should be recorded on the credit side because it's decreasing, and supply should be recorded on the debit side because it's increasing. So now let's go to the third step, which is recording the journal entry. As I said earlier in the previous slide, that the journal entry represents two lines. The first line represents the debit side. The account that should be recorded on the debit should be on the first line. The account that should be recorded on the credit, it will be on the second line. So as I said earlier, that the supply is increasing, and since the supply is asset, so it means that I have to record the supply in the first line. Why? Because the supply is increasing on the debit side, and the first line of the journal entry is representing the debit side. So I'm gonna record the supply, as you can see, in the first line, and I'm going to put 2,500 on the debit side. Because the cash is decreasing, I'm gonna record it as the second line in the journal entry because it's decreasing on the credit side, and the second line always represents the credit side. So that's why I record cash, and I record also 2,500 on the credit side. The fourth step here is to post the accounts in a T accounts. So I have now supplies and I have cash. So I need to draw a T account for the supply, and I'm going to record the 2,500 on the left hand side. Why? Because I should record it on the debit side because the supply is increasing. And also I need to record a second T account for the cash. Okay, so now if you're asking me why there is here 30,000 on the debit side, 30,000 from the debit side, because you can see here it's referenced to a transaction number 1. So we have 30,000 already from transaction number 1, and in transaction number 2 we have 2,500 on the credit side. Why? Because the company pays cash and the pay is decreasing on the credit side. Okay, now let's transaction number 3. Now, the company as well, they pay 26,000 cash for equipment. So the company purchase equipment and they pay cash. The company, they purchase equipment and they pay cash. So if I'm going to analyze it, I'm going to say that my equipment is increasing because I just purchased it, and my cash is decreasing because I just paid it. Again, if my cash is decreasing, cash is an asset. If it will decrease on the credit side. Equipment, it's an asset, but the equipment is increasing because I just purchased it. So where I'm going to record it, I'm going to record it on the debit side. So let's go to the third step to record the journal entry. As I said earlier, the journal entry represents two lines. The first line represents the debit side. So what should I record on the first line? I'm going to record the equipment because the equipment is increasing. And if it will increase on the debit side. So that's why I record equipment 26,000 on the debit side. And on the second line of the journal entry, I'm going to record the cash. Why I'm going to record the cash on the second line? Because the second line represents the credit account and the cash is decreasing. That's why I'm going to record it on the credit side with 26,000. Now the fourth step is we have to post those kind of accounts in the T account. So I need to draw a T account for the equipment, and I have to record that I have 26,000 on the debit side. And I have to record as well the cash on the T account. So I record here 26,000 on the credit side. And why I'm writing here, why there is number 3 next to the 26,000, which means that this is 26,000 of transaction 3. So there is numbers here, and each number is referring to which transaction that I already did. Let's move to seeing the transaction number 4. So here Fast forward, they purchase 7,100 of supplies on credit from a suppliers. So now what happened here? The company, they purchase supplies. So of course, if I purchase supplies, it means that my supplies is increasing. But did I pay cash? No. I purchased it on credit. I did not pay a cash. So now the company has a liability. Why they have a liability? Because they purchased supplies, but they did not pay yet. So if I'm going to analyze the transaction, I'm going to say my supplies is increasing because I just purchased supply, but my accounts payable is increasing. Why my accounts payable is increasing? Because I did some purchases on credit and I did not pay now. That's why I have an obligation. I have a responsibility to pay the money back. That's why my liability is increasing. So now we know that supply is an asset. And since the supply is increasing, it means I have to record the supply on the debit side because the normal balance of the asset is debit. But when it comes to the accounts payable it's a liability and the accounts payable is increasing. Then where should I record it? Because the accounts payable normal balance is credit, so the accounts payable should be recorded on the credit side. Now remember, the third step is to record the journal entry. And as I said, there should be one account on the debit side, another account on the credit side. So now which account I have to record it on the first line of the journal entry? Of course, I have to record the supply because as I mentioned earlier that the first line of the journal entry represent the debit side or represent the account that should be on the debit side. So now we know that supplies is increasing and supply is an asset. So I have to record it on the debit side. That's why we record supply 7,100 on the debit side. And accounts payable, it's also increasing, but the normal balance of liability, it's credit side. So that's why I have to record the accounts payable on the second line to represent the credit side. And I record 7,100. The fourth step is to record or to post those accounts in T accounts. So I have to draw one account of supply. I already draw one. So I'm going to add here 7,100 and I'm going to record it as number 4 to refer to the transaction number 4. And then again I have to draw another T account for accounts payable. And I'm going to record 7,100 on the credit side. So basically, step number 4 is we need to draw a T account for each of the accounts that appeared in the transaction. Now let's move to processing transaction 5. So first step, let us identify the transaction. So they say here, fast forward, they provide a consulting service and they immediately collect 4,200 as a cash. So the company, they provide the service and they're done and they receive directly the cash. So how we are going to analyze the transaction? The company, they provide the service and they complete the service and they receive cash. So cash will increase and revenue will increase. Again here, the cash is increasing and the cash is an asset and the normal balance of the asset is debit. So the cash should be recorded in the debit side because it's increasing. And then consulting revenue or revenue is part of the equity. And we already noticed that, or already we know that the normal balance of the revenue is credit, which means if it will increase on the credit side. So now the cash is going to increase on the debit side because it's an asset and it's increasing. And the revenue is going to increase on the revenue and the credit side because the normal balance of the revenue is credit. So how I'm going to record it in the journal entry? I'm going to say cash to consulting revenue. Why I start with the cash in the first line? Because always the first line represent the account on the debit side. Why revenue on the second line in the journal entry? Because revenue, normal balance is credit and the revenue is increasing, and the second line always represent the credit account that should be recorded. Now the fourth step is the posting. Again, I'm going to draw the T account of the cash, and I'm going to record or draw a T account of consulting revenue. We can see that the cash here, because the cash is increasing, I'm going to write the transaction number. This is transaction number 5, and I'm going to record the 4,200 on the debit side of the T account of the cash. Why? Because we receive cash, so the cash is increasing on the debit side. When it comes to the consulting revenue, we draw the T account and we can see that we post the 4,200 on the credit side. Why? Because the revenue is increasing. So if it's increasing, I have to record it in the credit side. So let's move now to the processing. Okay, so now let's see processing transaction number 6. So the transaction says here that fast forward, they pay 1,000 cash for December rent. So the company, now what they did, they pay cash. So the cash is going outside the company. So it means that my cash is decreasing. And why did I pay the cash 1,000? I paid for a rent. And as you know that, since the rent is something that we are going to pay it regularly or every month, so we are going to consider the rent as expense. So if we want now to analyze on step 2, analyze the transaction, so we can say cash is decreasing and rent expense is increasing. Now you are going to ask me, yes, you are saying that the rent expense is increasing, but whatever is showing here is decreasing. Yes, it's decreasing because it will decrease the equity, but in general, the expenses is going to increase. Now, for step 3, I have to record the journal entry. Now, as I said earlier, that the cash here we have is decreasing. So if the cash is decreasing, it means that I have to record it on the credit side. But when it comes to rent expense normal balance, if my expenses are increasing, then I have to record it in the debit side. So now cash will be on the credit side because it's decreasing, and rent expense is going to be recorded on the debit side because it is increasing. So this is step 3, where we need to record the journal entry. As I said earlier, that the first line of the journal entry represents the debit account. So the rent expense will be on the first line. Why? Because rent expense, it's the debit. It should be recorded in the debit side because the rent is increasing. The rent expense is increasing. And on the credit side, or the credit line, the second line, I have to record cash, and I'm going to record it 1,000 on the credit. The fourth step is what we call it the posting. So I have to draw a T account for rent expense, and I have to record the 1,000 on the debit side because my expenses are increasing. And I have also to record or to draw the T account for the cash. And as you can see, as I said earlier, you have to record the reference number of the transaction. So I can see here that 1,000 is on the credit side here in the T account. Why it's on the credit side? Because we just paid, and the cash, it means that it's decreasing. Okay, let's see processing transaction number 7. So the transaction here in step 1 says that fast forward, they pay 700 cash for employees' salary. Now the company pays cash. So what will happen to my cash? Because we paid, there is a cash outflow outside the company, is going outside the company. So that's why I have to say that my cash is decreasing. But why we're paying this 700 cash, we are paying it for employee salary. These salaries, because we are going to pay them on a regular basis or in a monthly basis, then the salary is for the company as an expense. So the company consider those kind of salary as an expense to them. So if I'm going to analyze it using the accounting equation, I'm going to say that my cash is decreasing and my salaries expense is increasing. Now do not get confused. I know that here it's written minus 700, which means that it's decreasing. these expenses will reduce or will decrease the equity in general. But now, when we are going to record it, we are going to say that my expenses are increasing. So if I go to step 3 to record those transactions, of course, I'm going to start with salaries expense on the debit side. Why I have to record the salaries expense on the first line? As I said earlier, always the first line represent the debit account. And since our salaries expense are increasing, I have to record it in the first line. So I wrote salaries expense and 700 in the debit side. Then on the second line of the journal entry, I'm going to record cash. Why I'm going to record cash on the second line? Because the cash is decreasing. So when it's decreased, it decreases on the credit side. So the fourth step, which is what we call the posting, again, I'm going to record, or I'm going to draw as a T account for salaries expense, and I'm going to record the 700 on the debit side. Why on the debit side? Because my expenses are increasing. And I'm going also to record or to draw what we call it the T account for the cash, and I'm going to put the 700 on the credit side. Why on the credit side? Because the cash is decreasing, because the company is paying the cash. Now let's move also to processing transaction. Now let's move on to transaction 9. So in this transaction, they told me that fast forward now, they receive 1,900 from the client billed in transaction 8. So in the previous slide, we said that the company provided services, but they did not receive the money yet from the customer. So that's why we recorded account receivable to consulting revenue and rental revenue. Now the customer, he came back to us and he gave me a cash. So if the customer pay me a cash, I receive a cash. So what will happen to my cash? Of course, my cash is going to increase. And at the same time, my account receivable, it should be decreased. Why my account receivable, it should be decreased? Because I received the money. If I receive the money, then my account receivable should decrease. Okay, so now how I'm going to record it? Remember, when we are recording the journal entry, it's necessary that you have one account is going to be on the debit and the other is going to be on the credit. So now what is going to be on the debit side? The cash. So that's why the cash is on the first line. Why the cash is on the first line? Because I receive cash, it means my cash is increasing, and the normal balance of the asset is debit. So if it will increase on the debit side. But the account receivable, because we receive the money from the customer, so I have to decrease my account receivable because the money is received already. So I'm going to decrease my account receivable on the credit side. So now what will happen on the fourth step? I'm going to draw the T account of cash and I'm going to record 1,900 on the debit side. Why on the debit side? Because the cash is increasing. And then I have to record another T account for the account receivable. So we can see here from transaction 8, we have 1,900 on the debit side. When we did not receive the money yet from the customer, then I recorded 1,900. But now in transaction 9, we received the 1,900. So I'm going to put the 1,900 on the credit side. Okay. Now let's see processing transaction number 10. So the transaction here, they say fast forward, they pay the Caltech Supply 900 cash towards the payable of transaction 4. So what happened first in transaction 4? In transaction 4, if you go back to transaction 4 in the slides, you will find that the company fast forward, they purchase supplies on credit. So because they purchase supplies on credit in transaction 4, we say that the supply increase and the accounts payable also increase. Why we say the accounts payable increase in transaction 4? Because the company did not pay the cash yet. But now in transaction 10, fast forward now is going to pay their accounts payable. So now if we are going to analyze it, we are going to see that the cash is going to decrease because now the company is going to pay. So their cash is decreasing. If the cash is decreasing, it will decrease on the credit side. Now, the accounts payable, is also going to decrease. Why? Because now the company is going to pay their liability. So now we need to reduce, we need to close our liability. Why? Because we are paying now. So the normal balance of the accounts payable is credit. So if the accounts payable increase, it will increase on the credit side. But if it will decrease on the debit side. So now the accounts payable is decreasing, which means that when I'm going to record it, I have to record it on the debit side. So let's see here how we are going to record the journal entry. Of course, I'm going to start with the accounts payable in the first line. Why? Because the accounts payable is decreasing. And if the accounts payable it will decrease on the debit side. Since the accounts payable is decreasing on the debit side, so when I'm going to write or record my journal entry, I have to start with the accounts payable because the accounts payable is decreasing on the debit side. Then on the second line, I'm going to record cash. Why cash is on the second line of the journal entry? Because the cash is decreasing on the credit side. As I mentioned earlier in the beginning of the chapter, the journal entry here, the first line always represents the account that will be on the debit side, and the second line is going to represent the account on the credit side. So now the fourth step, I have to draw the T account for the accounts payable, okay, and I have also to record the T accounts for the cash. As you can see here, that here in the T account we have in transaction 10 we pay 900 of our accounts payable. And why 900 in the debit side? Because we pay and the accounts payable or my obligation is going to reduce. For the cash, I have to record the cash in the T account in the credit side. Why? Because I'm paying, which means that my cash is decreasing. Let's move with the processing transaction number 11. Now, Chas Tyler, which is the owner, he withdrew 200 cash from Fast Forward for personal use. So now the owner, he withdrew money outside the company. So now what will happen? How we are going to analyze this transaction? Because he withdrew money, which means the cash of the company is going to reduce, it will going to decrease. So my cash is decreasing and my withdrawals also will increase. Now again, you're going to ask me why it's increasing and it's showing here minus 200. Because withdrawals in general decreases the equity. But because I'm withdrawing, I will say my withdrawing is increasing. So now, cash is going to be recorded because it's decreasing, it's going to be recorded on the credit side. And withdrawal, because my withdrawal is increasing, is going to be recorded in the debit side. So when I'm going to record my journal entry, I will say withdrawal to cash. Why withdrawal is on the first line? Because withdrawal is increasing and it will increase on the debit side. Why cash is on the second line in the journal entry? Because the cash is decreasing because we just withdraw money outside the company. So now for the step number 4, I'm going to draw the T account for withdrawals and I have to record 200 in the debit side because my withdrawal increases. And I have also to draw the T account for cash and it should be recorded for transaction 11 on the credit side 200. Why on the credit side? Because we just withdraw money, which means my cash is reducing and it will be reduced on the credit side. Let's move now for the processing transaction number 12. So now they say that Fast Forward, they receive 3,000 cash in advance of providing consulting services to a customer. Now let's read this carefully, and this is very important, by the way, slides, so please focus. So now I'm the company Fast Forward and the customer pay me $3,000 cash in advance. So me as a company, I receive the money in order to provide for them a service, but I did not complete the service yet. Yes, I receive cash. I receive it in advance. In advance of what? In advance of providing the consulting services. It means I receive the cash before completing the service. So now what will increase? Of course, my cash is going to increase in the company because I received the cash. So my cash is increasing. But should I record the other account as a revenue? Not at all. Why not revenue? Because if I want to record revenue, I have to complete the service yet, then I have to record it. But here I received the cash before completing the service. So my cash is going to increase and my unearned revenue was going to increase. What is unearned? Unearned is a liability. I cannot now record it as a revenue because I did not complete the service. If you receive the cash before the service is completed, then you have to record cash and account an unearned revenue. Why unearned revenue? Because I have a liability as a company to complete the service first, then I have to record it as a revenue. This is very important. So, and now cash is, because the cash is increasing, I'm going to record the cash on the debit side. But unearned revenue, it's a liability and it's increasing as well. And we know that the normal balance of the liability is credit. So now when I'm going to record my journal entry, I'm going to say cash to unearned consulting revenue. Why the cash is on the debit side? Because we just received 3,000. So it's increasing on the debit side. That's why we write the cash on the first line. Why my unearned consulting revenue is on the second line? Because unearned revenue, it's a liability. And the normal and my liability is increasing. And the normal balance of the liability is credit. So that's why I have to record it on the second line of the journal entry. So now the fourth step, which is the posting, where I need to draw the T account for the cash and I have to record the transaction 12 3,000. It should be on the debit side. Why? Because we receive cash. And I have to record as well, or to draw what we call it the T account for the unearned revenue, and I have to record the 3,000 on the credit side. Why on the credit side? Because my liability is increasing, and if my liability is increasing, I have to record it on the credit side because this is the normal balance. Now let's move on with processing transaction number 13. So now they told me here, fast forward, they pay 2,400 cash. So we paid 2,400 cash. So when we say paid, it means that my cash is decreasing. But we paid for what? We paid for insurance, and this insurance is covering 24-month insurance policy. So what does that mean? It means that I paid in advance 2,400 cash. I paid it. For what? For an insurance. This is an insurance, so you have to remember. It means that I paid it, but I did not use it yet. So remember, this is what will happen. So this means that I have prepaid insurance. And prepaid insurance is an asset. Since I pay in advance for an insurance, but I did not use the insurance yet, so I'm going to record it as a prepaid. So what will happen here? My cash will decrease. Why my cash is going to decrease? Because I'm paying. And what will increase? My prepaid insurance. Why my prepaid insurance is increasing? Because I paid for the insurance, but I did not use the money yet. So still I'm having the money and my money is increasing. So I have, how I'm going to record it, because I know now the cash is decreasing, and since the cash is decreasing, I have to record it on the debit side, but my prepaid account is increasing, so I'm going to record it on the debit side. So when we are going to record the journal entry, we'll say prepaid insurance to cash. Why prepaid is on the first line in the journal entry? Because prepaid insurance is increasing. Why it's increasing? Because yes, I do understand that I pay for the insurance, but I did not use the money yet. So still I can call it as an asset. But I paid cash, my cash is going to decrease. So in step 4, I'm going to open a T account for the prepaid insurance, and I'm going to record 2,400 on the debit side. Why? Because I did not use the money yet and I paid it in advance for the insurance. So I'm going to consider it as an asset, which increases on the debit side. And I'm going to open again or draw a T account for the cash, and since I paid, so my cash is decreasing on the credit side by 2,400. So now let's move on to processing transaction 14. Here what happens that fast forward, they pay 120 cash for supply. So the company purchases supply for 120. So now how we are going to analyze it? So because we pay, so my cash is going to decrease by 120, and because I purchase supplies, so my supplies will increase. So now how I'm going to record the journal entry here? So of course, because the supply is increasing and supply is an asset, so it will go. I have to record it on the debit side, and cash is decreasing, and the cash is an asset. It means that I should record it on the credit side. So I'm going to say in the journal entry supplies to cash, and when I'm going to record it in the T account, or I'm going to post it in the T account, I have to say supplies. I have to draw the the T account for the supplies, and I have to record the 120 on the debit side. Why on the debit side? Because we purchase supply, and if we purchase supply, it means that it will increase on the debit side. Again, for the cash, I have to draw and post the 120 in the credit side. Why on the credit side? Because we just purchase, which means that we pay some cash. Now let's move on to processing transaction 15. So fast forward, they pay 305 cash for December utilities expenses. Here, what do I mean by utilities expenses? Utilities expenses, it means expenses related to the electricity and water. We usually call it as utility expenses. And here, because those are expenses, which means that we are going to pay it on a regular basis or a monthly basis. So what will happen here if we pay? So it means my cash, if I'm going to analyze it, my cash is going to decrease by 305, and my expenses are going to increase by 305. So we know that the cash, because the cash is decreasing, so it will decrease on the credit side, and utilities expense, because it's increasing, it will increase on the debit side. So when we are going to record the entry, we have to start with utilities expense in the first line, because it's increasing, and usually the normal balance of the utilities expense or the expenses is on the debit side. And on the second line, I'm going to record cash because cash is decreasing, so I have to record it on the second line, which represent the debit side. Then when it comes to the step 4, to post those two accounts, I have to draw a utility expense T account where I have to record 305 in the debit side because my expenses are increasing and the normal balance of the expenses are debit. And then I have to also to record and post the 305 in the T account of cash, and I have to record it on the credit side because we just paid, and it means that my cash is reducing, so I have to record it on the credit side. Now moving on to a processing transaction number 16. The journal entry or the transaction here is fast forward, they pay 700 cash in employee salary for work performed later in December. So what happened here? So basically the company pay cash 700. Why? They paid for salary, or employees' salary. So here, because the company is paying, so my cash is going to decrease, and because we are going to pay the salary of the employees, and usually the salary is going to be paid on a monthly basis, on a regular basis, so we consider the salaries as an expense to the company. And we know that the salaries means that if I pay salaries expense, it means my expenses are increasing. So when I'm going to record it, I have to record salaries expense and the journal entry in the first line. Why? Because my expenses are increasing. If my expenses are increasing, so the normal balance of the expenses is the debit side. So if it will increase always on the debit side. That's why it's on the first line of the journal entry. Then the second line is the cash, and the cash here is recorded on the second line, which is representing the credit because the company is paying, so the cash is decreasing, and usually the cash or the asset, if it will decrease, it will decrease on the credit side. And again, in the fourth step, we have to what we call it, to post it in the T account. So I have to open or draw a T account of salaries expense, and I have to record the 700 on the debit side. Why on the debit side? Because my expenses are increasing and the normal balance of the expenses are a debit. So it means if it will increase, I have to record it on the debit side. Then for the cash, I have to post the 700 on the credit side. Why? Because we are paying, and since we are paying, my cash is going to decrease, and if it decreases, I have to record it on the credit side. So as you can see here, those are summary transaction in the ledger. So here, all of the T accounts that we already post, all of the transaction in each and every T accounts of each accounts here. So if you can see here, now after recording all of the entry, as I said earlier, the T account will help us to see the effect or the balances of each account. How I'm going to see the balances of each account? Let's take an example of the cash. Can you just focus on the cash T account? So we have a debit side, 30,000, 4,200, 1,900, and 3,000. And on the credit side, we have 2,500, 26,000, 1,000, 700, 900, 200, 2,400, 120, 305, and 700. So now if I ask you and told you what is the balance of the cash, now we know that there is a lots of transaction happened on the cash side. So if I ask you what is the balance of the cash, so what you are going to do, you are going to take the total credit. And the last learning objective in this chapter is to prepare and explain the use of trial balance. So what do I mean by trial balance? To prepare the trial balance, we have 3 steps. But please make sure that you understand and differentiate that trial balance is not part of the financial statement. We usually prepare it as a draft, which help us to prepare the financial statements. So remember, trial balance is not part of the financial statement. It's just we prepare it in order to help us to prepare later on the financial statements. So how we are going to prepare it, we have 3 steps. First, I need to list each account title and its amount from the T account. As you see earlier, in when we summarized the transaction, in the T account, we took the balances of each account. So I'm going to take each of the balance of each account, like for example, the cash balance, the accounts receivable balance, the supplies balance, the equipment balance, all the balances from the T accounts. I'm going to take them and use them for when I'm preparing the trial balance. Then the second thing, I have to compute the balances for the debit balances and the total of the credit balances. And then I have to verify if my trial balance is correct, the total debit should be equal to the total credit. So now let's just see an example of what is a trial balance. This is how the trial balance looks like. Again, I have to mention that the trial balance is not a financial statement. This is a statement or a table that we usually prepare before preparing the financial statements, but it's not part of the financial statement. As you see in Exhibit 2-14, that when we are going to prepare the trial balance, we usually start in the first line with the company name. Then the second line, we have to state that this is a trial balance. And the third line, we have to state this trial balance is prepared for which period, for which month. So the trial balance usually includes debit and credit as a table. So we have one column for the debit and the other column for the credit. So when you are going to prepare it, you always need to start with the asset account. So we can see here we have an asset account: cash, account receivable, supplies, prepaid insurance, and equipment. When you are preparing the trial balance, you have to start with the asset accounts. Okay, then you are going to record 4,275. From where did I get the 4,275? This is the balance that I calculate earlier from the T account. So if you go to slide 34, where I explain the summarizing transaction in a T account, you will find that the balance of the cash was 4,275. Then the account receivable is 0. From where I get 0, why it's 0, if you go again to slide 34, you will find that in the T account that the balance of the accounts receivable was 0. Supplies was 9,720, which is the balance. So from where I get the balance, again, I get the balance from the T account that was on slide number 34, and so on. Then the second item that I have to include liability. Any liabilities I have to record them after the assets. So here I have accounts payable, and the accounts payable total was balance 6,200. From where again I got this balance? I got this balance from the T account of the accounts payable in slide 34. And I record the 6,200 on the credit side because the balance of the accounts payable was on the credit side. Then I have to record all of the equity item. So we record the unearned, and unearned also consulting revenue is also part of the liability. And capital is 30,000. The balance of the capital is 30,000, and I record it on the credit side. The withdrawal, I record 200 on the debit side because, as you know, that withdrawal normal balance is on the debit side. That's why I have to record it on the debit side. Then the consulting revenue is 5,200. So I record the consulting revenue on the credit side because the normal balance of the revenue is credit. And rental revenue 300 also on the credit side because the normal balance of revenue is credit. For the expenses, all of the expenses, salaries expense, rent expense, utilities expense is all on the debit side. So now, if you want to know that the trial balance is correct, the total debit should be equal to the total credit. So here the total debit is 45,300 and the total credit is 45,300. If the total debit equals to the total credit, it means that you analyze the transaction correctly, you calculate the balances of each account correctly because your trial balance is also equally, total debit is equal to the total credit. If it's equal in the trial balance, it means that whatever you did earlier is correct. So after preparing the trial balance, now you can prepare the financial statements. Can prepare the financial statement, income statement, statements of owner's equity, and balance sheet. And we already learned how to do this in chapter 1. So if you still have some question related to the financial statements, please refer to chapter 1 part 2 and go back to the financial statement and read them again. And this is the end of chapter 2.